Good morning and good afternoon. Welcome to the last ICISA webinar of this year. We always schedule it on the last Tuesday of the month, and we figure you've got something else to do on the last Tuesday of December. So we will see each other in January. But first, we are extremely proud to present some great minds of our member Swiss Re. And they will be presenting a research paper called Credit and Surety in the Age of Economic Uncertainty. With us here, we have Martin Pfister. Martin is the head of Credit and Surety of Swiss Re. And Martin, I invite you to take the floor and introduce your colleagues, please.
Thank you, Richard. And really on behalf of Swiss Re, I would like to express my sincere thanks to you, Richard, and to ICISA for giving us the opportunity to present our latest piece of research on the credit insurance and surety industry in this joint webinar. As you know, our flagship Sigma reports are part of our DNA here at Swiss Re, and we have published research reports on credit and surety for decades, the most recent one dating back to 2014. And a lot has happened since 2014, and hence we thought the time is ripe for an update, and I'm very pleased about the report that our business unit wrote together with our colleagues from the Swiss Re Institute and that we could publish in September this year. Today with me, we have Jérôme Hägerli, our Swiss Re's Group Chief Economist, and from his team, Li Jing, Head Insurance Market Analysis, as well as economist Arnaud Manoy. As well as from my team, we have underwriting analyst Antoine Gilliot, and so thank you all for having made this expertise publication possible. In the next 45 minutes, Jérôme will start with a general macroeconomic outlook. After that, we will have Arnaud and Antoine, who will present some of our key findings from the report, and then we will follow up with Q&A. So thank you all for being here with us today, and with that, the floor is yours, Jérôme.
Well, thanks a lot, Martin, and great to have so many people watching this webinar. And please get ready also with questions at the end. The whole webinar is for 45 minutes, and we make sure we have ample time for your question. So, as Martin said, it was high time we actually did again a credit and surety report, and it's definitely this age of economic uncertainty. If you look at this big ship, yes, we still have a lot of trade activity globally, even though the last few quarters were not that strong. We had seen the first quarter of 2023 trade growth being positive for both goods and services, but the outlook ahead, and especially when we look ahead for 2024, is one for weaker growth, weaker trade in goods and services. And here, what credit and surety can provide, I think, is really, really interesting, and I think also really super important. So let me start with a few highlights from the global economic perspective. As we also published, besides the credit and surety piece, we also published just last week our latest Sigma outlook for 2024 and 2025. If you go to the next slide, what to remember. And for sure, I will share with you a slide with key macroeconomic statistics, and Arno will do the same on the insurance front. But if there's something to take away from our presentation today, please take away the letter R. And why R? Well, it's very, very simple. R, it stands for resilience. Credit and surety can provide and does provide more resilience. And fact is, according to our Sigma research that we put into place 2018, and we're doing updates on a yearly basis on the macro and insurance market resilience front, fact is economic resilience, defined as the shock absorption capacity of our economies, households, to actually be able to absorb the next shock, which definitely will come again unexpected. That resilience has weakened. And our analysis very clearly shows today economic resilience is weaker than in 2008. And I think here the insurance function really kicks in and is important, because insurance and credit and surety as a central piece of that. It provides resilience exactly at times like now, which are characterized by the age of economic uncertainty, age of much higher than economic volatility than what we were used to over the last 15 years, but also given some of the tectonic shifts that we are seeing on the economic front. So R, it stands for economic resilience. We need more of it. R, it also stands for the risks, and clearly the risks and the macro risks, they have increased. I will talk about that very briefly as well. Well, at least the one item which I think is really positive and we shouldn't underestimate is the power of interest rates, and it's the power of another R of real rates. Finally, real rates are positive, and with positive real rates, the markets we're operating in, be it insurance markets, be it capital markets, be it the real economy, it just works much better. And the power of interest rates for insurance industry, it also means we can provide much more coverage than before because of the higher running yield that one can expect with the higher interest rates. And on the capital market front, higher interest rates, it's also very positive because the anchor of risk-free rate, which is another R, it's not return free again. And us as long-term investors, but also I think the society with the savings and the pensions industry, they also profit from it. One other R, I think, which is important to mention is the R, and I think there also it's an important one for the credit and surety business. It's the R of reindustrialization. What do I mean with reindustrialization? With reindustrialization, I mean the fact that key regions, key countries, the superpowers, they invest more in national policies, either to rebuild back better, like in the US on the infrastructure front, on the real infrastructure front, on the physical infrastructure front, but also on the digital front, or then confronting the need for greening the economy, which also needs more investments. All this together, this reindustrialization of our economies, it will also mean the need for more credit and surety. And here, I think, again, that's an area where our industry can provide a lot of resilience, and definitely we need it. Now, with this, I would like to go to the next one, which is, given that basically I have 1 more month to go, the key question, at least the short-term question, is now, how will 2024 look like? Well, that's, I think, a super easy question. First of all, it won't look like 2022. Remember 2022. 2022 was the year we were faced with the interest rate shocks. You had seen interest rates going to from negative in Europe to levels of 0 to 1% in the US, going back to normal into positive territory. You had seen also 2022, that was the year the central banks needed to catch up and actually change the course of action so that we have a chance to regain back price stability, economic price stability. And 2022 was the year that you couldn't hide anywhere in capital markets. You actually lost about 15% from a total return perspective, both on the equity front as well as the fixed income front. So 2024, in my view, won't look like 2022. I think that's pretty clear because also the peak of interest rates hikes is behind us. Second, I don't think next year will look like 2008. 2008 was a global financial crisis. Definitely, there is more economic pain to come. Europe today is probably in a recession. We don't expect US to go in a recession, but we had seen in 2023 a period, especially in the first half of this year, with a lot of financial market stress, some regional banks in the US which came under stress, and also very important, systemically important Swiss bank which came under stress. Still, 2008, if you compare 2008 to 2023 and 2024, we are in a better position. Banks are safer. We also have monetary policies and the framework for unconventional monetary policies, which can kick in if if needed, and they would kick in if needed with emergency actions. Now you might wonder, why 1969? Well, 1969, that was the year of the first moon landing, first person on the moon, US moon landing. And once we had the moon landing, actually, the talk about from Fed economists and academic economists also started about soft landings. And soft landing is a landing of an economy where almost in almost a magical way, growth slows down, inflation slows down, and there is no much economic pain in that process. Well, in our perspective, we won't have a soft landing in the US. And fact is also, a soft landing actually is a much rarer event than a moon landing. So definitely looking ahead, we are in an age of economic uncertainty. So with this, and finally, let me share the key point forecast. Yes, we do also a point forecast at Swiss Re, and we take care also a lot in the Sigma research team of scenarios. And here we show you our baseline scenario in our latest Sigma report, which is downloadable from the Swiss Re Institute webpage. We also find our alternative scenarios. I won't go into details, but please have a look. You see with the SRI Swiss Re Institute's forecast, which is the economic research forecast relative to market consensus, and you see number one, economic growth. Yes, global growth is set to slow down, and is set to slow down quite noticeably from around 2.6% this year to 2.2% according to our forecast. This is noticeably slower and weaker than the market consensus. And second, we also believe that inflation pressure, while it's coming down, it will remain high. And please don't mix up disinflation with deflation. Disinflation is what is happening now. Now the inflation pressure is coming down, and inflation pressure is the first derivative of prices, so the price changes. Prices are still increasing, but at a less magnitude than in the past. And I say this because the shock for living cost is still in the system, and that also will mean more economic pain coupled with higher interest rates. So global economic growth is going to come down. Global inflation is also going to come down, but the pressure continues to be there. And what's more, if you look at various regions, you see actually that according to our forecast, that is underpinning the report, underpinning the analysis that you see in this report, the divergence that we are expecting, had been expecting in the past, we continue to expect, meaning the US most likely will do still much better than Europe. And that's just, as I just said at the beginning, Europe is probably in a recession as we speak. And it's never good if you have the locomotive of Europe, Germany, being in a technical recession. And most likely Germany will have a full year next year of negative growth rate. Maybe last point on the monetary policy front, on interest rate front, we do also factor in our forecast that the central banks will be cutting next year. Actually, we expect them to do so, but less than market consensus, actually much less than market consensus. And the risks is that the market expectations will be disappointed. The risk is that central banks actually will rather not cut rates than cutting as much as the market expectation expects. And what this means actually more economic pain. And this is something definitely, if you're in the credit and surety business, to think about and also factor into your costing and into your analysis. Let me go to the next slide on the scenarios. I've just hinted it before. We do economic scenarios, and economic scenarios, we use them internally for our group planning purposes. These are scenarios with specific levels for the macro parameters you have seen before, and attached to that, we also provide specific levels for the financial market metrics. On this slide, what you see is the risk scenario factors which we are watching. So we are watching inflation risk, doesn't come to a surprise, will have a negative impact. Yes, inflation is coming down, but the pressure is still here. That's why the trend is not so much yet positive. We shouldn't get too relaxed on the inflation front. I think something we shouldn't get relaxed at all is also the political risk and the social unrest. Let's not forget, next year will be a super important election year in the US, and let's not also forget the elections which has happened close in Europe, in the middle of Europe, in Netherlands. We are seeing more polarization on the political front, and I think with the cost of living crisis, we shouldn't also be surprised of more social unrest. And I think also with the situation in the Middle East, we should also be extremely careful in terms of terrorism. Terrorism hopefully doesn't get back to the level we had seen in the past, but there's definitely a risk thereof. Something to watch out is obviously the question also, how are we going to fight the next crisis? Because we can't use the means of the last crisis, meaning more monetary stimulus, given that the inflation is not back to target, and neither do we have the public balance sheets to support, again, a war-like stimulus the way we had done it during the pandemic. That's why the debt sustainability question, the question of, are we going to see a divergence between spreads in Germany, France, and Italy? Is that going to come back again in Europe? I don't think it's unthinkable at all. And I think in that age of economic uncertainty and not having the buffers in place to fight the next crisis, it's also something I think we should keep close to home in terms of watching and also be prepared for. So with this, let me hand over to Arno. Thank you.
Thank you very much, Jerome. So yeah, if we go on the next slide. So we have seen the global context for the macroeconomy. Now, before diving into the credit and surety topics per se, let me just give a brief overview of what we see for the non-life or the P&C primary insurance industry. So firstly, I will start with the headline. So further rate hardening and higher interest rates to support premium growth and profitability. So here we see once again some of the R's that Jerome mentioned. So real interest rates, but then also the repricing of risk for insurance. That's a key topic at the moment. Looking at the story more in detail. So first of all, we have claims. The inflation, the strong inflation that we have seen that Jerome has mentioned for the past 2 years, that has created a strong increase in insurance claims, of course, and losses. And Jerome has mentioned not to confuse disinflation with deflation. It's right that now inflation is slowing, but it's not actually reverting. So the claims will continue to, the claim severity will continue to be there. It will continue to increase. And it's also reinforced by the long-term upward trend in nat cat losses, but also by social inflation. Besides, it's right that for some categories of goods, for example, the price of used cars, the price have now meaningfully decreased. That is correct. But then on the other end, you have still ongoing inflation with wages or healthcare costs. Those are typically sticky components. So they will continue to impact insurance claims, and they will continue to cause some losses for the industry. So what does it mean? The repricing of risk. Insurers have to, or they have been increasing the pricing. We have seen that for reinsurance. We have seen that for the commercial property market for quite some time already. We think that will actually continue, at least in the near term. Moreover, we think also on commercial liability, there are some, as I said, with the wages, social inflation, etc. There is also some insurers will have to take some pricing actions. And moreover, for what's about personal lines. So because of affordability reasons, insurers had been maybe a bit late to increase the pricing on personal lines, but they are now doing it at a fast clip. We are seeing that both in the US and in Europe, for example. So there is really broad-based hardening of the market. So that boosts the premium growth, even though we still think that because of the low or soft economic activity, premium growth will be below the recent trend, but it will still be better than it was in 2022 and 2023. But then that also supports the profitability, and higher interest rates also support the profitability. So we have those two combined forces on the underwriting and investment side, and that will, we think, increase the return of equity of the primary insurance industry for non-life to around 10% in the next 2 years. So this is higher than 2023, and this is also higher than the long-term, the past 10-year average, which is around 7%. So significant improvement, but that doesn't mean that insurers are able to close the so-called profitability gap. Why is that? Because insurers in the insurance industry, they expect a certain return. This is the so-called cost of capital, and that has increased because of the higher interest rates. Insurers can more easily have a risk-free return that has gone higher. So the threshold, the bar that insurers have to meet for their return on equity, that has also gone up. And in fact, we think that even with this high ROE of 10%, it's unlikely that insurers will close completely the profitability gap in the next 2 years. So with that, let me now dive into the credit and surety topics specifically. So this is just an overview of the market size or the market development. Overall, credit and surety generates premiums of around 33 billion. So it's in fact fairly small. It's only 1 or 2% of the total P&C industry. But the growth is good. There has been the long term for both credit and surety growth of around 5 to 6% annually on average, which is a little bit higher than the overall P&C market growth for premiums. Looking at trade credit insurance specifically, so just as a brief reminder, trade credit insurance protects a transaction between a seller and a buyer. So when you sell a good, you may think there may be a risk that maybe the buyer will not be able to pay, or that they will go bankrupt. So then you can take trade credit insurance. In 2022, we estimate that this market, in terms of premium volumes, was around 14 billion. And it has grown quite a lot, actually. In 2022, we estimate by around 11%. The sector mostly covered, well, first of all, this is goods, or rather than services that are covered. And then typical industry includes metals and chemicals industry, retail trade, agri-food, also electrical equipment or construction. So it's relatively varied, in fact. You can see from the charts on the left that Europe has more than the majority, around 60% of the global premiums for this industry. And this is simply for historical reasons. Trade credit insurance initially developed in Europe. And it also means that Europe has the highest, among the 4 regions that we're showing here, it has the highest penetration rate. So penetration rate is simply the ratio of the insurance premiums over GDP. That said, despite the high penetration rate in Europe, it has been fairly constant over the past decades. Asia, on the contrary, has seen an increase in the penetration rate, especially 10 or 15 years ago, driven by China. But now that penetration rate in Asia has also flattened, partly because simply the export intensity of the Chinese economy has decreased a little bit since then. That penetration is partly limited by the fact that there are competing projects for trade credit, in particular from banks, and also because in some cases, or often, insurers have not been able to reach new markets. For example, the SME market doesn't have a high penetration for trade credit. Now looking at surety insurance on the right, so you can see this is a market worth around 19 billion of premium. And the growth rate in 2022 was also very strong, also in the low double digits, so that's quite good. To explain a little bit what this is about, so surety is maybe a bit unusual for a category of insurance. This is a tripartite agreement between an insurer, a beneficiary, and a principal or a contractor. So because this is commonly used in public construction, you could say that, for example, the beneficiary is a public agency, could be a city or a government, and they want to start or to develop a new construction project. And so the contractor for this construction project will be the so-called principal in this model. And depending on the regulations, it may be that the principal has to take up a surety bond, and they will do so with the insurer. So in fact, this is a bit unusual because the agent purchasing the coverage is a principal, the contractor, it is not the beneficiary of the insurance cover. As I said, surety is quite dependent on regulation. It is not necessarily something that will be taken up by the contractor just for the sake of it. It is often requested, and it's more common in public construction, but you also have surety bonding in, for example, judicial or custom or tax activities. So because of this nature driven by regulation, the penetration is quite divergent across different markets. For example, in the US, the public construction industry requires the use of surety bond. This is the so-called Miller Act of 1935. And this explains why the US is almost half, around 45% of the total global market for surety, so 8.5 billion of premium, more or less. Outside of the US, surety is also quite common in South Korea, but also in some Latin America markets, such as Brazil and Colombia. Here, the penetration rate has also been, for a long time, relatively constant throughout the 21st century, although in the past few years, there has been a slight increase driven by several regions, in fact. So with that, we have a good overview of credit and surety. And let me now just also illustrate a little bit more the importance of this category of insurance. As Jerome has mentioned, this is related to resilience. Credit and surety really matters for the economy and for supply chains, in particular because it creates resilience. Looking at trade credit first, so trade credit is a so-called lubricant of trade and supply chains because it makes it easier when you're contracting with or transacting with a buyer in a foreign market abroad on another continent, for example. There may be some uncertainty. You may not know the market very well, or there may be some gaps in communications, for example. So taking trade credit insurance will allow to kind of compensate for this uncertainty and provide some resilience and allow the exchange to take place. And in fact, ICISA's own numbers show that trade credit insurance protected around 13% of world's goods trade in 2022, which is quite high. On surety is also an enabler of business, something that creates resilience because it ensures that the commitment to perform is met. Sureties, the insurance companies that provide surety bonding, they do not just provide a financial payout, but they can also provide performance support, for example, through legal expertise or simply project management expertise, and that may allow to move the project forward. And in fact, there are studies that show that using surety for a project increases the chances of success of the project, it increases the timeliness, it reduces the costs. So overall, surety really allows to reduce uncertainty and bring some efficiency into the economy. So this is quite valuable. We have seen that credit and surety is quite linked to macroeconomy, and indeed on the next slide we can see on the next slide, please. We can see some of the drivers that credit and surety insurers look at for what's going on for the trends in credit and surety. So you have, first of all, GDP growth and trade and manufacturing more generally. So those are drivers of premium growth and also exposure, simply because when you have more economic activity and more trade activity, this is what can be insured by nature. So that will create demand, premiums, and exposure. Thank you. And also in the case of GDP and trade, that also, if there is strong economic activity, that also improves the credit environment, the creditworthiness of the different parties, and the chances of success of a project for surety. So that also matters for claims or losses for those categories of insurance. And I have to say, trade and manufacturing is closely related to trade credit, not necessarily to surety. And GDP growth, well, it's a rough proxy for the growth of both credit and surety. Corporate insolvencies, bankruptcies, or the probabilities of default as well. This is something that credit and surety insurers follow quite closely, because for both trade credit and surety, the origin of a claim is often simply insolvency or the bankruptcy of a company or a project that cannot be conducted or completed. because of the default of payment, for example. So this matters a lot. And with insolvency waves, you also have a wave of losses for the insurers. So that matters a lot. Insolvencies and bankruptcies matter more for trade credit than for surety, but there is also a link in the two cases. Moreover, inflation and interest rates, so the two usually go in link, hand in hand, because when you have high inflation, this will be followed by high interest rates. Inflation can also be a driver of exposure or premium growth, just because it decreases the value of the risk of what can be insured. But more importantly, both inflation and interest rates have an impact on the profitability of businesses, on the probabilities of default. And so with high inflation or high interest rates, this can increase the claims or the losses for insurers. So this is really key. And finally, public construction spending or output, especially public, as I said, this is the bread and butter for surety. So this drives the demand and the exposure and the premium growth for surety. So those variables show that both credit insurance and surety are cyclical business. They will go up and down. Profitability and premiums growth will go up and down based on those macroeconomic drivers. But as I said, the cyclicality is maybe a bit stronger on the trade credit side. Now we'll hand over to Antoine, who will talk a little bit more about those cycles that I mentioned and also the outlook. Thank you.
Yeah, thank you, Arnaud and Jérôme, for setting the scene. And let's now dive into trade credit insurance more specifically. And Arnaud, you mentioned that this line of business is closely linked to global trade, and this is what we show on the left side of this slide, where we put side by side the growth of the trade credit market with the growth of world merchandise trade. And you can clearly see the correlation between these two indicators. And this graph also shows that trade credit insurance has accompanied some of the large trends or events we have seen in the past 2 decades. So after China joined the WTO, these were years of high economic growth in the country, and at the same time, the trade credit insurance market has also grown significantly in China, also driving growth rate for the global trade credit market. You see the crisis in 2009 that led to a significant shock to the world merchandise trade and another decrease in the trade credit insurance market. And what is important to note here is that the growth rate in trade credit on this graph also contains the premium rate adjustment. So in time of crisis, as losses tend to increase, insurer adjust their premium rate. They ask for higher premium for the same amount of risk, and this increase in premium rate mitigates the impact of the crisis on the growth of the overall market. So you see in 2009 that the decrease in the trade credit market is not as large as the one observed on the world trade side. And this mechanism were also at play in 2020 during the COVID crisis, which you also see on the right of this chart, and although in a less severe manner. And you see the consecutive year in 21 and 22 where the both markets have recovered. So that's for the market size, but what will also probably interest insurer and reinsurer in the audience is the result of the line. And this is what we show on the right side, with the blue line being an estimation for the global trade credit insurance loss ratio over the past 50 years, which we put next to the recession indicator for the United States. So this indicator indicates how many months in a given year experience a recessionary environment. You can clearly see the correlation between the two indicators. But what is also striking in this graph is that this historical correlation disappeared in 2020 during the COVID crisis. Even though the shock to the global GDP growth was larger in 2020 compared to the global financial crisis, loss ratios in trade credit insurance have decreased. And there are different explanations to that, but the two crises were of different natures. The consumer demand was maintained overall during the COVID crisis, whereas it significantly decreased during the global financial crisis. The lockdown measures in 2020 also reduced supply, but not as much as the reduction we saw in 2008 and 9. And also this crisis called for a different response from the government. In 2020, the amount of fiscal stimulus provided by government was significantly higher compared to the global financial crisis, and government acted also much faster. So this measure had a stronger impact to support the economy. There were also in 2020 modification of insolvency laws in several key markets where governments gave more flexibility to companies in financial distress, for example, by increasing the threshold at which a legal action could be intended against them. So all in all, these measures led to a decrease in corporate insolvencies in 2020 and 2021, which then led to the decrease in the loss ratio we see in trade credit insurance in this graph. Let's now move to the next slide and talk about surety. And for surety, it's more challenging to draw a global conclusion because the market is more heterogeneous. Because there are different type of products that all rely on the same mechanism Arnaud described earlier, but that are applied to different situations or sectors. So, for example, a surety bond that protects the completion of a public infrastructure project will not have the same drivers as custom bonds that ensures that an importer will pay its import duties to the customs authorities. But we can still observe in large markets where contract surety dominates, such as in the United States, is a clear correlation between the market size and public investments in infrastructure. And this is what we show in the graph on the left side with the US surety premium growth rate put together with the growth of investments in public infrastructure with a 1-year lag. And on the result side, on the right, we again show the loss ratios in US surety compared with US recession years. And you see that the correlation between the observed loss ratios and recession is less obvious than for trade credit insurance. And there are different factors that on which insurers have an influence and that mitigate this correlation. So with a solid underwriting, insurers can also select risks that are better equipped to face times of economic deterioration. They can also intervene when they see that the contractor is facing difficulties to complete a project. And after a claim, they also have means to mitigate losses. And all these elements explain why the correlation is not as strong. And you can clearly see during the global financial crisis, despite the magnitude of the crisis in the United States, that loss ratio in the surety market remain well under control. So let's move now to the next slide and talk about the outlook for our markets. And in the short term, maybe one of the key indicators to watch are insolvency rates. As you mentioned, Arnaud, these are often usually at the origin of a claim in credit and surety. And the graph on the left side shows insolvency growth rate for a selection of advanced economies. And you clearly see the reduction in insolvencies during the COVID crisis, which I referred to earlier. And as the government support measures were gradually phased out, we have seen a normalization of these insolvencies towards the pre-pandemic level or above. And now, as the effect of higher interest rates are also transmitted to the economy, we expect this increase to continue into 2024. You may also notice on the graph that not all markets are synchronized. The increase in the UK is not occurred faster than more rapidly than in the United States, this can also partly be explained by the different support measures that were put in place across the countries, where some had a longer lasting effect than others. But all in all, across all markets, insolvencies are rising now, and in 2024 we expect that this increase will be driven by Europe and North America. So for trade credit insurance, it means that we expect claims activity to continue increasing next year, which should also lead to an increase in premium rates. And over the longer term, as the economic situation stabilizes, loss ratio should come back to lower levels. Maybe a word on the construction sector, which is more relevant for Surety. This is a sector where a number of challenges are accumulating, with the higher interest rate that constrain the access to credit of companies, higher price of inputs, the supply chain issues, the shortages in labor supply. So these are all factors that make it more difficult for contractors to pursue their project, but also for surety companies to intervene to help for the completion of a project or to mitigate losses after a claim. Over the longer term in surety, what is worth being mentioned are the different investment bills that have been passed in key markets, such as in the United States or in Europe. These bills, such as the Infrastructure Investment and Jobs Act, allocate significant amount of money for the modernization, the development of infrastructure, and the energy transition. And we expect that these investments will support the growth of the surety market in the coming years, although the effect will be likely spread over several years and will also take time to be felt. A final word on the infrastructure investments. We expect most of the investments until 2040 to be done in emerging markets led by China and India, where surety could again play a role as the surety market was recently developed in China. Let's now move to the key takeaways for this presentation. So you've heard that we are going through a time of high economic uncertainty. In just 3 years, we have gone through the first global pandemic in 100 years, with the massive economic consequences that followed. We lived through the Ukraine-Russia war, and we expect that global economic activity will slow considerably in 2024. But in this time of economic uncertainty, as Jérôme and Arnaud explained, trade credit and surety insurance play a role in providing resilience to the sectors they support, such as manufacturing and public construction. In the near term, we expect that our industry will also face these economic challenges with a higher claims activity. But if you take a step back, you will realize that these products, trade credit insurance and surety, have been developed at the end of the 19th century. So they have been tested repeatedly. They have gone through several crises. And so the tools at the disposal of insurers to overcome the future challenges are already known and tested. So that concludes the presentation. If you like the topics we discussed today, I invite you to download the report Credit and Surety in the Age of Economic Uncertainty, which we published earlier in September. And if you want to dive deeper into macroeconomic or insurance-related topics, I invite you to take a look at the Sigma publication from the Swiss Re Institute, as well as expertise publication on more specific aspects, and monthly economic outlook forecast. So that's it for the presentation of today, and we are happy to take your questions.
So, gentlemen, thank you very much. And I think apart from being a thorough piece of research, what I hear is a rare mix of realism based on solid work, solid analysis, and optimism for our line of business. And I think in these times, with high interest rates, increased inflation, we can all use a dose of optimism. So thank you very much. Now, we are at the 45-minute mark, which was announced at the beginning, but I think we still have time for a couple of questions. And I got a question in to start with. Given the usual uncertainty in contracting over projects, could one of you please explain why surety is not more commonly used?
Yeah, I'm happy to take that one. So I think this refers to the fact that surety, the penetration rate in the surety market are highly related to the regulations and also to the fact that banks provide competing products that are called bank guarantees. And in certain markets, such as in the United States or Canada, the regulation restrict the role of banks that banks can have in public infrastructure projects. So this gives a bigger share of the market to insurer, whereas in Europe, you see that banks typically have a higher share of the market. So that's for the competition bank insurance. And there's beyond that, there can also be other factors that explain why a product is less used in a market, is maybe linked to the fundamentals that may not be present, such as solid insolvency laws that allow insurers the rights to recover potential losses. So these are also alternative explanations.
Yeah, and I think it's a perfectly good explanation. And the follow-on question is, there have been a lot of announcements of infrastructure projects, both in the US and in Europe. Now, given what was said on sovereign debt, given what we see happening on interest rates, are you worried that these infrastructure projects will actually take place?
I'm happy to take this question, and maybe Arno, you wanted to add. I'm not worried. Actually, I'm hopeful. I'm actually very hopeful that we're going to see more public investments. I think what is really important is that we don't just have more public investments, but that the public funds for the investments is used to catalyze private investors' funds. And as you might know, Richard, Swiss Re has been calling and have been personally involved there in the G20, and so the World Bank as former co-chair of infrastructure facility. What we really look for is infrastructure being a tradable asset class. What's important is that public funds come in so that we have a deepening of the markets, so that they open up the place and lower barriers so that more private sector funds can flow. And it's definitely tougher if you have higher interest rates for it to work, right? In terms of the financing aspects for infrastructure investments. But then I think there's also now a lot of recognition, and I think that is something which has changed over the last 5 years. There's a lot of recognition now that decarbonization of our economies and together climate adaptation, it's a win-win. It's good for growth. It's good for jobs. It's good for growth, and it's also good for our planet. And we don't have a planet B. And maybe one more point on the overview slide that we showed with all the initiatives. Maybe we also have an inflation, right, on the infrastructure initiative front, but which is actually not a bad thing to have. But there's also a lot of construction which is probably going to come on board when you think about the announcement at the last G20 meeting from India and Saudi Arabia, the corridor between Middle East and Europe. That's going to be a very important corridor, a lot of infrastructure investment which could be flowing, construction, engineering expertise will be required, but also the coverage for credit and surety will be required. And that's taking place in an area of Europe also, where you are competing with banks. You are banking-based capital market model, but the expertise that we can provide in pricing risk, assessing the risk, and providing solutions, risk transfer is pretty unique. So actually, I'm actually very hopeful and optimistic about the future of infrastructure. Maybe Arno, from you wanted to add also a point or two.
Not to disagree with you, Jerome, but there are for sure some maybe near-term challenges to this reindustrialization. For example, we've seen in Germany with the recent fiscal policy tussle, the electoral cycle matters. That there is, in Germany, the current coalition wants to implement some of those projects, but there are also some parties that are more in favor of maintaining public debt level, and so which may mean that so some of those projects that were going to be financed in Germany could be cancelled. In the US also, I think we've also heard Donald Trump say that if re-elected, he may attempt to cancel all or part of the Inflation Reduction Act. So those are still barriers, but I think, like Jerome said, the structural trends are supportive indeed.
Now, what intrigues me is infrastructure as a tradable asset class. And if something becomes tradable, investors want to take out risks as much as possible. Now, we've been talking about the Ontario model, whereby instead of a small percentage of a project, a much larger, say 50% is bonded, together with some additional securities. Would that help? And given the rising corporate failures, is that something that we should strive for?
I do think so. I mean, Ontario model is one. There are other initiatives out there. The asset recycling initiative in Australia, which was put into place around 2014. Yes, almost 10 years ago. But I think is also valid. I think there's no silver bullet on the infrastructure front. But what's important is we need to make sure that the barriers to investments, that will not be, we won't be able to completely remove them, but we need to ease and remove restrictions for long-term investors like pension funds, also mutual funds, but then also insurance companies. And insurance companies, 1/3 of the 70 to 80 trillion dollars of assets under management, that they can invest better into long-term assets, and infrastructure investments are long-term assets. Now, it's fact also, Richard, that the bankability of infrastructure projects, we don't have too much infrastructure projects. We would, if you compare demand versus supply, demand outstrips supply. But again, if you would have a tradable asset class, while it still remains extremely bespoken as corporate bonds are bespoken, it would ease the financing aspects. I would have zero doubt about it. But for that, we need leadership. And leadership would need to come either from the multilateral development banks, like a World Bank or like an IFC, setting the gold standard and saying how tradable asset class looks like with bond market documentation, everything that comes with it, or then the US with its deepest financial markets taking the leadership, and they have done it. They have the capabilities definitely to do it. Think about the Build for America bonds during the Obama presidency. Also, municipal bond market is being partly used for infrastructure investments. I think what we need is initiatives, political initiatives, for that, obviously we have to wait. But now we have to wait quite some time. But Inflation Reduction Act, it may be less about bringing inflation down than actually implementing infrastructure investment. And I'm sure in case we would have a new political leadership in the US, we will have maybe a different name for the same thing, which is more investment in the US. and which is also what is going to happen, I think, in Europe. So the environment, for me, it's definitely a good one for credit and surety.
Thank you. Extremely.
A lot. But, Richard, your question really excited me. That's why I responded for so long time. Thank you.
And a good response it was. Thank you, Jerome. I think we have time for just one more question, and there are a couple more. But let me put one to you, gentlemen, which really keeps me awake at night. And that is, we see disruptions in supply chains. We see fragmentation. We see nearshoring, friendshoring, reshoring, everything shoring. What is your view on the interest in the impact on credit and surety, especially on trade credit insurance?
Antoine, do you want to take that one, or do I go ahead?
You can go ahead and complete.
Yeah. Yes, thanks. Yeah. So what I would say is, yeah, it's right. I mean, there is a fear that with the geopolitical events, the various trade restrictions, protectionism, there is a risk that indeed we see less globalization, and that also could impact insurance. But I think this has to be nuanced. I think, yeah, Jerome, you mentioned the India, Middle East, Europe trade corridor. This is in fact more globalization, so not less. And also in Asia, in 2021, we had the Regional Comprehensive Economic Partnership, which also goes in the way of removing some of the trade barriers, so having more globalization. So in fact, it's more nuanced than the protectionism or geopolitical issues that we are seeing. And moreover, when you look at the impact on credit and surety of those changes, it's not that clear cut, because in the end, for the insurers, it doesn't matter if there is an exchange being done between China and the US or Vietnam and the US. In the end, there will be the same requirement for insurance or the same risk to cover. So yeah, it's more a matter of if there is really a strong degree of reshoring, many things being produced in the US for the US, then perhaps there is less uncertainty, there is more clarity in transactions, so there would be maybe less of a risk to insure. But even if you have US to Mexico transactions, Mexico is also a different market for the US customers. There is different regulations, different language, different practices, and that has to be insured as well. So yeah, that's to say the trade restriction, geopolitical issues. The impact is not really that bad on insurance. Thank you.
Well, thank you so much. And if I look at the clock, it is 4:00 CET, 3 in London. Gentlemen, and I thank you very, very much for bringing this excellent piece of research to the fore. I think you will be quoted very, very often. A word to the audience. Thank you very much. In case your colleagues, your friends, your family, of course your family, missed this webinar, it will be published on our website, so you can access it from there, along with the PowerPoint presentation that was shown. If you have questions to the presenters, please send them to secretariat@icisa.org, and we will make sure that they get them. With that, all that remains for me is to wish you a good holiday season, which for reinsurers is code for a great renewal. And I hope to see you all again, happy, healthy, and doing business in 2024. So signing off from London this time, this is ICISA. Thank you so much for your attention.
Thank you.
Thank you very much.
Thank you, Richard. Bye all. Thank you.